and welcome to the Daily Revision Morning Show. My name is Lysandra Everett, and I am your host. I am here Monday through Friday, 9 o'clock-ish. And let me tell you what I talk about on this show. This show, I talk about life things. I talk about three main things. I talk about life things, personal development things, and I talk about taxes. And today is Tax Tuesday. So every Tuesday, I talk about a tax topic. And then on Fridays is Q&A Friday. So questions that I get throughout the week, I answer them on Fridays. So if you are also, if you have not done so, make sure you subscribe to my live notifications so you don't miss anything, and share this out. And somebody has put a spam comment on my broadcast. Ain't that something? Okay, so let me know who you are and where you're from. And if this is your first time with me, welcome, welcome. And I appreciate you spending your time with me. Hey, Dr. Stephanie, how are you? So, Dr. Steph, I got to send you an email. I saw somebody in your area doing some really cool things about what we were talking about. So I got to send you this email. You might even know this person. But anywho, so I am here every Monday through Friday, and I'm usually here for about 15-20 minutes-ish, unless it gets to be a really good topic. And then, sometimes I might go a little over, but I'm usually about 15-20 minutes. So give me one quick moment. Let me share this out, and then we are going to get started. All right. So I want to get there, and then I want to share this out. Taking me a minute here. Sorry. Okay. So, we're going to be talking about commingling of funds today. I got to tell you about one of my latest experiences. It's crazy. So, but how are things going with you? What you got new going on? I like to know what's going on with y'all, really. And thank you for sharing, Dr. Stephanie. I appreciate it. And listen, whenever you guys share my broadcasts and leave comments and stuff, I really do appreciate them. And so I usually try to make sure I express my gratitude, because I do not take it for granted at all. Okay? I really don't. One more, and then we're going to get started. And the reason why I have to take a minute to do this is because I'm on my computer. There's a delay, so I have to give it a moment to pop up and then share this while we're on, and then keep it moving. And this is also simulcast on my fan page as well. So thank you for those of you who are watching from my fan page and from my profile. Okay, so let's get down to it. What is commingling of funds? Okay, let me tell you what happened, and then we'll talk about it. I had this client that is going through an audit, and they're being audited because the IRS is saying, hey, you're not paying us enough in taxes. And so what's happened is they have to produce the profit and loss statement for their business. Now, the problem is they don't have one. So what they have asked me to do is they, given me this stack of bank accounts, and I'm having to separate all of their purchases. So that is not good. That is not good. So here's the deal. When you have a business, and it doesn't matter what your business structure is, you should have a separate account for your business. And you don't have to go buy or start a business account per se, because a lot of times, especially when you're starting out, business accounts can have a pretty hefty bank fee that you really don't need to pay up front. So just having a separate checking account is enough to get started for you to have your business, but to keep those funds separate. So commingling is when you have your business funds and your personal funds. They're just all mushed in together, right? They're blended into a whole is what the definition of commingling is. It's something that's blended into a whole. So there's really no separation between you, your personal, and your business. So what does this look like? You have your what you call your business, it's all going into one account. So you're paying for business stuff, you're paying for personal stuff, you might be going shopping, you might be paying a business bill, but it's all there together. There is no separation. Now, some of this is tax law, and I'm not a tax attorney, but I can tell you from a tax perspective how this affects you, and just want to explain what it is. So if you have this issue, if you're not sure, I recommend that you consult a tax attorney or a corporate attorney, definitely a CPA, and to help you with that, because as tax preparers, that's not our lane. Our lane as tax preparers is filing taxes. The setup of that stuff, that's where you have the CPAs, corporate attorneys, and tax attorneys. Okay, we can only tell you how it affects you from the tax perspective. So in this particular case, the IRS is telling this lady, this business owner, hey, you're not paying us enough taxes. But the only way that she can say yes I am or no I'm not is to know exactly what her business expenditures are. And she can't know that because it's all in one big pile. Okay, so you're really doing all of this without any record, rhyme, or reason. So you might have this is all about how you run your business. Okay, so even just transferring $25 from your business account to your personal account might not seem like a big deal. However, when you don't have any type of documentation to support that transfer, whether it's a salary, a bonus, or something, if you don't have anything like that to support why you're transferring this money, then that's still commingling. So even though they might be separate, you still have to have some kind of documentation to support why you're moving those funds. Now, when you're getting started, this isn't that big a deal. Meaning that, you might have just a little bit of money coming in. But the point is that where you start is not where you stay. If you decide to incorporate, whether you incorporate, have an LLC or something like that, you really need to have that separation of funds, because you're going to hear the term that's called piercing the corporate veil. What does that mean? So when you have your business structure, as an LLC, for instance, when you have that business structure, you have certain protections that separate your company from your personal liabilities. That protects you personally from your company liabilities. Okay. However, when you are commingling funds, when you are just basically being all willy-nilly about your finances when it comes to your business, then the IRS does some basically a test. I want to say it's like 8 questions or something that they can look and say, okay, no, you are not operating as a separate entity. Therefore, you become personally liable for any kind of tax liability. So this is why the separation of the business is important. Now, as a sole proprietor, now this is the thing about sole proprietorship. You are personally liable regardless, because there's no separation of you from the business. So even though when you get started, most people get started as a sole proprietor. I don't know anybody that doesn't get started as a sole proprietor. When you get started as a sole proprietor, there is no separation of the business, you from the business. You are the business. So when you die, your business dies. Okay, that's what a sole proprietorship is. Even if you sell it, you're still selling assets, and so you're still going to have to pay taxes on the money that you get from that. Okay. There's no separation, but it's when you start to to incorporate an S corporation, a partnership, an LLC, that type of thing, that you really start to separate you from your business, right? Now, when it comes down to the funds need to be separate as well. Again, you can have just 2 separate bank accounts so that anything that's business related is coming out of one account. Anything that's personally related comes out of another account. Let me give you an idea of what this client did. Now, this client was going to the ATM 4 or 5 times a day. Now, I don't know any business that goes to the ATM, right? Who uses their business as an ATM? That's just not how this works, right? So, but what happened is, and so now there's no accounting for those funds. There's no accounting that says this is where this money went that I withdrew from the ATM for my business. There's nothing. So it's going to be pretty difficult for this person to explain where did all of this ATM money go if this is your business. See, this is what you have to explain for the IRS, because when you're talking about deductions, it's your deductions and expenses and all of that that reduces your tax liability to the IRS. Now, if you are not separating that, if you don't have any type of documentation to support what you're doing, the IRS says, okay, if you don't have the documentation, then you can't prove it. Therefore, you can't deduct it. Hi, Bernetta. Thank you so much for joining in. So if you don't have any kind of proof, then the IRS says, okay, I'm sorry, you can't deduct this. This is not a business expense. Okay, so then this is where it's going to affect your tax liability, because this is why tracking is so important when you're talking about your business expenses. And this is why it's great to have all of this stuff come out of one account, because you can track going to Staples. Now, you still got to have a receipt that shows what your business expenses are, but you can say, I went to Staples, it came out of this bank account. Yes, business ledgers. Oh my gosh. It is really about keeping track and keeping these things separate. And as you grow, listen, when you get to the point where you're making, I don't know, you start getting a 5-figure business a year at least, you need to have someone that is your CPA that is really helping you with this, because as the business owner, you can't do all of this stuff. Okay, you cannot. So when your business starts to grow, you need to have your team of people. You need to have a CPA. You need to have an attorney. You need to have a tax preparer. All right. And a lot of times, and here's something else. I'm just going to throw this in here. We'll get back to the commingling part. Here's the other thing I want to throw in here. Most people want to say, well, my CPA does my taxes. Yes, that is true. That is possible. But most CPAs I know, they want to stick to the accounting part and then let an enrolled agent or an experienced tax preparer stick to the tax preparation part. All right. Because the focus is completely different. Accounting laws and tax laws are two totally different things. Okay. You do have some CPAs that do specialize in taxes. That's okay. But most CPAs, they want to keep that separate so their brain can be focused on one thing. Right? Now, when it comes down to commingling of funds, this is where it's very difficult to back up your claims, because this is what the IRS is looking for. And this is where a lot of times as small business owners, we totally fail at this, is keeping track and keeping documentation to substantiate your deductions and your expenses. Even if you do go out to a business lunch, just having that on your bank statement is not good enough. You need to have the receipt that shows the date, the time, who you were with, why you were with them. So if you and Betty went to lunch and you were expecting Betty to give you some referrals, all of that needs to be documented so that you can substantiate your deduction. Your travel. If you've got the where you went, the purpose, and there's some other there's some other things with travel, but you've got to be able to prove that this travel was, for a business purpose, how it's going to affect your business, what you were expecting to get from it, whether it's continuing education or what have you. You've got to be able to substantiate those things with receipts and documentation. All right. So let's talk about now, we know what commingling is putting everything is just going into one pot. You're using your business account to pay for personal stuff. You're using your personal money to pay for business stuff. You got to stop all that. Okay. So how do we do it? Well, first you've got to separate the money. You need to have one account where all of your income goes. And especially as internet marketers, we have, if you're an internet marketer, an affiliate marketer, you got money coming from everywhere. Okay. You can have 10, 12 streams of income depending on how many products you promote and all of this stuff. Okay. But you need to have one source to where your income goes. Then you need to separate and save, like 30% strictly for taxes. Okay. Just set that apart. All right. Even if you put it in a little tax account, however you do it, you got to separate it. You need to establish a salary for yourself. What? I didn't go into business to have to pay myself a salary. I didn't do that. That's what a job does. Why do you think the jobs do it? They have to know how much they're going to pay you. So they know how much in taxes to withhold. Okay. This is, so even though you don't like a job, guess what? You are an employee of your own business. You have to treat it like that. All right. So you have to set your salary, how much you're going to pay yourself, even if it's in a percentage. All right. Even if it's in a percentage. So you might set aside 30% of your income for taxes. You might set aside 30% as income for you. However you divide that up, you've got to have a method by which you can show how you are managing your business funds. All right. So you have to pay that out of your business account. Now, let's say that you need to use some of your personal money, because you do. All right. When you're just getting started out, you're going to be using some of your personal money to run your business. That's just life. But when you document that, that is additional capital added to your business for whatever. But you still have to have an accounting of how that income to your business was being used. Okay. And so this is why you need a corporate attorney to help you establish the correct business structure for you. This is why you need to have an accountant to make sure that there's proper accounting for your funds. And then that prevents this whole commingling thing. Because once the IRS again pierces the corporate veil, I mean, I need for them to find a less dramatic term for that, but that's just what it's called. Okay. But once the IRS pierces that corporate veil, then you become personally liable for any of the company liabilities. It takes away all of the protection that you set up with an LLC or an S corporation or a partnership. You set these things up to protect your personal assets from being attached to any corporate liabilities. But when you commingle funds, it takes all of that protection away. So that's why it's important to not commingle funds. And even as a small business, this is a good habit to get into now. I don't care if you even I have a separate PayPal account. I have a separate PayPal account where I go put tax money. And so when it's time for me to pay taxes, I just transfer that to my business account and pay taxes. So even though you're small, this is how you start. Who is faithful in little, right, will be faithful in much. So let's be faithful in little now. So let me tell y'all something. When I got my first commission, online, it was 30 cents. Okay. It was 30 cents. Now, no, you cannot go and expect somebody to separate out a dime. Okay. That's just not going to happen. But what you need to do is be in that proper frame of mind, because at the end of the day, all right, if you wind up having to pay taxes, if you have separated those funds, first of all, from your business, from personal, and then set aside a specific amount for taxes, is not going to be such a blow to you. There are a lot of times that business owners get to tax time and then they owe taxes and they're about to stroke out. I had this one lady who didn't file because she started a home-based business because she wanted the tax write-off. Well, she went and balled it out on her home-based business. She showed where she had a profit, and then she had to pay taxes on that profit, and she about died. Hey, Beth, Hey, Sean, I don't know if I said hi. You see about die. So when you're making income monthly, you need to set aside about 25 to 30% in taxes. If it winds up that you don't owe taxes, fantastic. Then you've got a nice little nest egg to reinvest into your business. But you have separated those funds in preparation for doing that. So all of my home-based business owners, you need to have a separate account. That's right, Bernetta. If you got a business, you got to operate as a business. And listen, this is not stuff, and this is the thing that bugs me about home-based businesses. Now, listen, I love home-based businesses, great tax deductions, but the part that they don't tell you is the flip side, really, in how to operate in a business. Okay? Because they tell you, let's start this business. It's great tax deductions and all of that. Yes, that is true. However, you are not, when you're first getting started out, you're expected to operate at a loss. That's what the IRS expects. But the IRS also expects you to operate in a profit as well. All right. Or else you don't get all those deductions. You're a hobby then. That's a whole nother live broadcast. All right. So you have to be prepared to pay taxes on your income. Your business is not going to always offset your personal liability. I got you, Beth. I'll take care of you, girl. But what they don't teach you in the home-based business is really how to operate as a business, how to really separate those funds and make good business decisions for your business, not for the company, for your business. Okay. So, but because what happens is this, let me tell you what happens. And then I think I'll be done talking about commingling. What happens is people start these businesses, like I said, expecting to get these tax write-offs, which, yes, you do. You get lots of tax benefits, but listen, you got to have documentation to support those business deductions, okay? You get that. But the flip side of this is you have to be in profit 3 out of 5 years in order for the IRS to consider you a business. Other than that, you're considered a hobby and you don't get to take all of those deductions. You only get to deduct up to the amount of income that you bring in. Okay. So with commingling, again, with commingling, this is what gives you your financial protection. This is what substantiates you with the IRS that, you are keeping your business separated. You are operating separately as a business and you're just not grouping it all together. Because once you do that, and as long as you do that, then you potentially make yourself personally liable for any of the corporate liabilities. Okay, so I really hope this helps you out. You're definitely welcome to share this with people. Listen, go separate the money. Go separate it. Go get just a regular old checking account. Don't tell them it's business, because business checking accounts, they cost a lot more money. Okay, just go separate the money. All right, that's the first and foremost thing. Go separate the money. And guys, listen, start now, really checking out your deductions and all of that. You got receipts. Listen, y'all, to keep my receipts, because this is one of the things people ask me, Lysandra, how do you keep up with your receipts? I have an envelope that I put all of my receipts in. If they're there, they're not going anywhere. So even if it takes me 2 months, and sometimes it does, even if it takes me 2 months to go back and do all my expenses and everything, even if it takes me 2 months, I haven't lost a receipt. Okay. So you gotta have the receipts. Just having the line item on your credit card statements and stuff is just not enough. Okay. You're right, Bernetta. I probably should do a webinar on this, right? Just talking about how to do this whole thing. Okay, so listen, that's it for me. If you have any questions about it, shoot me an inbox and I'll catch it on Q&A Friday. Yesterday, we talked about trust. I can't even keep I keep a pouch in my car. Yes, keep the envelope, the pouch, the something in the car. Yes, yes, yes. Do that. So, yeah. So that's it for me, you guys. Like I said, I'll be here tomorrow. Tomorrow we're going to be talking about the anatomy of trust. Yesterday we talked about trust in business. So if you missed that, go back and check it out. I thought it was pretty good. It actually resonated with a lot of people. I was really surprised at that. But tomorrow we're going to talk about the anatomy of trust. Okay, so I will see you guys tomorrow, 9 o'clock-ish. Thanks so much for tuning in. Feel free to share this out. I appreciate it. All right, I'll see you guys next time. Bye.